What a close to the week. What a close to the day. What a close to the month. Really, really strong move into the close here today. That had really, really positive implications for the markets going into next week and into next month. So next week was a pretty pivotal week for us from a technical standpoint. And we may have already tipped our hands as to what next week, what the result of next week will ultimately be by how we finish today. So good move. And some people call it window dressing, whatever. And I'm sure there's reasons, but regardless, the strength of the move and the volume associated with it was big time, and helped us end the month on a very positive note, especially for the Dow Jones Industrial Average, which had been so embattled and on the verge of its own, pretty much in its own intermediate decline. Pretty weak, but at least in one. And things may have changed with today's rally. So really good move. I'm going to break down what happened, the technical implications of the move. We'll break down kind of what our expectations are now because of that for the S&P, for risk appetite just in general. We'll take a look at kind of what's driving this action. So it wouldn't be exactly what you'd expect. Even just the last 2 days when we've been relatively bullish, it wouldn't be what you'd expect it would be. But it's been a good thing that it was. So I'm going to explain that discrepancy there, that divergence. That's been a really positive for the markets. We'll take a look at some other asset classes, the moves that they're making, and then our trade idea, as always, is a stock like others that we did today in the technology space, no less, that had a reaction to its earnings announcement. And we'll talk about how to trade that reaction again like we did the last couple of days. So let's go ahead and get started. Today is Friday, May 31st, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. If you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video. This is where I take a look at old Market Outlook trades, see whether we should stay in them or get out of them. We already put today's trade on already before the market closed today. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do this day in and day out. It's a big deal for us. That's why we always ask. Those who don't, you can do it right now while you're watching with 1 or 2 really easy clicks. We can get to our goal of 100 likes on our Market Outlook tweet. All right, let's go ahead and get started and take a look at the S&P 500 with the market forecast indicator. Let's pull up the S&P 500 here. You can see the rebound, big rebound here at the end of the day today. We ended up with a 88-point range. So not only was it a big intraday move, but it really, this is our biggest range. The day of NVIDIA, the NVIDIA day, was an 85-point range, roughly. You can see this one here, 48.5. Over here, we were 82, 75, 67 without the gaps. So you can kind of see, this is our biggest range that we've had since April 15th, 2024. So just over a month and a half, or just about a month and a half. And on an up day, no less. So usually we get the bigger ranges on the down days, and we usually get them below the moving average. But this is well above. In fact, it's almost double. I mean, here we've been getting ranges like this one that was less than half of the average. And even yesterday's, when you're looking at 38 points, a little bit below the average. But now here, again, almost double. So very, very rare to get the kind of move we got here today on an intraday basis. And it really rebounded us from, again, we were down here at the lows of the day. We were down at 52.77. So we ended up closing above last week's low, and that's significant. I had multiple classes today at Market Scholars, and that was a big deal that we were going to be closing below last week's low. It was going to be relatively bearish, and this big time rally at the end of the day avoided that by 10 points. We ended up closing above that NVIDIA day low by 10 points there. So really, really important move, whether it's month end, whatever, the reason for it, regardless, from a technical standpoint, it was a very, very important move. The short-term sentiment improved in a big way. The momentum line rallied back up in the bullish territory. The near-term line rallied up into the upper half of the chart. So that's a good bounce on short-term sentiment. We'll see if we can continue that with the long lower shadow there. The intermediate line turned back up, actually. It's not only stayed above 80th percentile, but actually turned higher again. And market sentiment's still falling, but at least it's still in bullish territory, not falling precipitously. If you look at the Dow Jones Industrial Average, that was our biggest winner on the day, gaining more than what you saw in the S&P, almost an engulfing type pattern. Not closing above last week's low, so a little different from that regard, but still at least big time bounce above yesterday's high point. The intermediate line, or excuse me, the near-term line did cross above the intermediate line. So remember, the intermediate line just barely crossed below market sentiment yesterday. It's still below it. It was flirting with bullish, falling into bearish territory today. Avoided that. But now the near-term line crossing up above, way out of. Remember, we were so bearish here. But big time jump in short-term sentiment. Much better, right? That's a good bullish bounce, leading to some expectations of bullishness of next week. Same thing with the NASDAQ 100. Again, we avoided falling into the reversal zone. We were in the reversal zone on the near-term line at the lows of the day today, because this was down. Obviously you can see we still finished lower, just barely, but we were much lower, over 1% down to the downside. And the near-term line did not finish in the reversal zone. It ended up bouncing up in bullish territory. And your momentum line ended up bouncing all the way to the midpoint of the chart. So much better short-term sentiment. And then you can see the Russell 2000 had bounced yesterday already. And then continuing that today, the near-term line moving higher, the intermediate line moving higher, the near-term line close to crossing above the intermediate line. So you can see how this little rally kind of set us up for a good week next week. And a good week next week, and I talked about this in our portfolio management class, our long-term class that we have on our website. We talked about the importance that next week has to the type of month we might have for June. And so, at the time, we were near the lows of the day when we were having the class. And so the fact that we rebounded in such a big way really helped set the stage for a good week. We were kind of leaning towards a good week next week regardless, even when we were at the lows of the day today. But this little rally really kind of helps cement those expectations that we can get a good week next week, leading into a somewhat good month in June. I don't expect us to have as good a month as we did this month in May, but at least a move higher and avoiding a down month in the month of June. Let's take a look here. Let's really quickly come back to the S&P. Sorry, let's come here, S&P, and then take a look at the weekly chart. And you can see the weekly chart really changed too. So the momentum line bounced back up and came out of the bearish territory. Your near-term line still falling, but has not dropped into bearish levels yet, so that's a good sign. The Dow Jones, remember, has been the one that's been struggling the most. It did, the near-term line did jump or fall into bearish territory, which generally speaking coincides with an intermediate decline on it, and we're pretty darn close to one. But if you look at the SPX, again, the benefit here is like when we get these down weeks that we don't close below the low of the prior week, and we have a pretty good chance of going higher. The one instance here where we actually did have an intermediate confirmation signal. We had the chart today when I was doing my portfolio management class looked exactly like this one, almost exactly. The near-term line was right at the midpoint. The momentum line was oversold. It was set up for a bullish intermediate confirmation signal, hence why we were expecting a bullish move next week. And we got that. Maybe we already got the beginning of it today to close the market, as now we don't have an intermediate confirmation signal, but we also ended up not closing below last week's low. So last week's low was actually 52.56. Sorry, not the 67, but 56, 52.56.93, and we closed 20 points above the low point. So big time change in sentiment. And like I said, generally when you get these bearish moves where we don't close below the low, then we rebound with some good bullishness. And that would be my expectation, that we'll rebound here with some bullishness. Let's look at the other weekly chart. You can see the transition candle, but now that transition candle is not a bearish candle, not that big of a bearish candle. So now the likelihood of us getting a bearish candle next week is lower. Because remember, we're going to start, the Hakinyashi is going to start at 52.65. Well, we're trading above 52.60, or around 52.65, because it's the midpoint of this chart here. So we're going to be right around there. We're trading at 52.77 right now. So we're not going to get a bearish candle next week. We're going to probably, at worst, probably going to end up with another transition. Remember, if you get multiple transition candles, which are small bodies with upper and lower shadows on the Hakinyashi chart, then more than likely you get a continuation pattern, not a reversal. So very, very good. Very good day. Like, I can't say how good this close was enough. If you look at the 3 green arrow charts, your MACD improved on the S&P. You still got 2 red arrows. You still have 3 red arrows in the diamond, so we're 3 days into this. So we really need to follow up on that diamonds probably on Monday, so we can get the green arrow and get rid of that pink shading. Because the more days you get with pink shading, the more likely we are to get this kind, an intermediate decline. So we can't do what we did here, where we got the 3 red arrows bounce and then fail. Well, here's the bounce. We can't fail here. We need to really build on this move to the upside and break through and really get going. You see, you got the green arrow. You only have 1 red arrow now on the IWM. You still got 2 on the NASDAQ, because that was the last one to change. It stayed 3 greens for so long. So you got 2, but they're 2 very weak red arrows. And considering you're still above the moving average, we can turn green very quickly. So again, very good day from that regard. We ended up closing back above the 8-day moving average. So after closing below the 17, we're back above the 8. Now, that doesn't mean we're taking off to the upside. We're still in convergence mode, right? The MACD is still below its falling moving average. Look at that volume today. Big time volume. Again, we generally don't get, remember, we went this whole entire intermediate decline without a day with 1.5 times. We went this entire decline without a day with 1.5 times the average volume. That's very, very rare for that to be the case. But today the volume really picked up in a major, major way. So we did get a 1.5 times, which is kind of interesting because, again, like I said, more often that occurs on the down days, not so much on the up days. When you look at some of these other oscillators like the DMI, you still have the bearish crossover. You're above 25 on the negative. You're below 20 on the positive. So you haven't quite changed that yet because of the low point that we had. So that's something that kind of keep an eye on to see whether or not we get a failure next week. But in this case, remember how I told you yesterday that when you're below the 20 just barely, we can rebound. We can rebound on this and get back going again. Well, that's what we did. We rebounded. We're back above 25 on the positive. The negative's still above there, but that's a really, really good sign that we will continue to bounce back up. So very good move for the diamonds there. Looking at the RSI and the CCI, still at bullish levels on the S&P 500. You're back out of bearish territory, at least on the RSI. You're still kind of down there on the CCI, but you're out of bearish territory on the RSI. So that looks better than it did. The Ichimoku cloud has still got an intermediate trend strength, so that's good. Back above the green line on the S&P. The diamonds, remember, we lost the trends. We hit 0 a couple days ago, and we're still there. We still don't, have a very, very, but at least we're back above the cloud, right? So just like that, in one day, you went from being below the cloud to back above it. So very good sign there. And then finally, from a Bollinger Band perspective, we were at the midpoint of the chart. We're still not in that upper quartile, and the bandwidth is still declining towards a very narrow Keltner channel. And you can see the momentum is really coming down pretty rapidly. Remember, the diamonds had dropped, and you can see it has dropped into negative levels. But at least, again, we're back up above the Keltner channel. We're not, in the upper half of the chart bandwidth yet. That's still falling too. But we're not in the lowest quartile anymore, and we're not flirting with breaking below the lower band and having the Keltner channels, having the bands expand back out again. So that's very, very good sign. We talked about that potential, and again, we were kind of leaning towards things turning better anyway for the diamonds, and because of that CRM, right? That big CRM decline being kind of an exhaustion type move, potentially for the diamonds itself, because nothing else was that bearish. And lo and behold, you can see we did get that rebound there. Let's take a look at the today's intraday moves, and kind of what I was telling you. We ended up not closing below last week's low, so very, very good move. We closed above yesterday's high point. We filled in the gaps. Over here, we talked earlier this morning, I talked about the potential of filling in these two gaps. I didn't think it would happen today, but we filled in the one today, and we're well inside the other one as well. So that was in our Q&A session I have for our premium subscribers. That was our kind of what we were talking about, our expectations. I thought maybe that would happen early next week. Well, it happened in the last hour. Well, the last 20 minutes. We went from 522 to 527 just in a 20-minute time frame with a lot of volume, as you can see down there at the bottom. The big chunk of volume today occurring right at the very, very end of the day. Big time move up to the upside. That's, again, like I said, setting us up for a good June, that we can get a good June here. If you look at, I told you the volume and the trading range were higher. Let's take a look at the actual numbers again. We were at 9 points on the SPY. We're at 90 million shares trading hands. So let's look at those numbers in context. 9 points is way off the chart here for the ATR over the past 52 weeks. 90 million is not off the charts, but it's way up here at the top. I can remember how volume was so extremely low, and again that we don't want to get a lot of big days like this, because if we cross that 1,000, it generally coincides with downward moves. So we probably won't get a day like this on Monday. I would imagine now we're going to really start to quiet back down again as we head into the CPI and FOMC 2 weeks, not next week but the week after, which would actually be a good thing, right? Because then most likely that would coincide with the market rising as we grind and keeping us below this 1%, but not necessarily getting below 80, which is when we get to extremely low and we start to get concerned about reversals to the downside. So but at least the volume, which had been so extremely low to the downside, picking back up today was a very, very good sign. It would be nice if we don't have to necessarily maintain a bigger ranges, but if we can get decent volumes on this move, at least average volumes on these move, so we can try to get this back up to where we were around for most of this past year, around 70 or 80 million shares. I think that would be the most ideal without the bigger ranges, but with smaller ranges, hopefully, and which would be, because if that coincides with the bigger ranges, that will most likely mean that we're dropping next week into the month of June, and I don't think that will happen, and I don't think any of us really want that to happen. The VIX dropped big time today, down almost 11%, dropping to 13. So we finished the week right at 13, well below the 90% mark. So that's a benefit. The VVIX dropped back to extreme lows as the correlation jumped back up to pretty strong positive levels. So that's a good sign. That's not the greatest sign that the VVIX dropped so low to 78. Again, that's extremes. You can see when we're usually below 80. Here, if I were to look at the VVIX here, you can see it better. When we get below 80, anything below the red line is extremely low. And of course, if you get all the way down to 75, you're really extreme. So, in the past, it's led to a rally high. That doesn't necessarily have to go right away, but it generally has led to a move higher in the VVIX. And remember, with the positive correlation with the VIX, that generally leads to a move higher in the VIX. So hopefully we can kind of hang around here, right around these low 80s, maybe up or down a little bit, without the markets really taking off, without volatility, really taking off here in the next so many weeks. I've told you before that I think the zigzag chart at 7.13%, I don't think that that's going to be the ending number for that box. I think it is going to get bigger. I do think it's going to get kind of in that 8 to 10% range before we get our next 5% decline. Remember, that box can get smaller because you just start a new box. It doesn't get smaller as you pull back, but it can get bigger. And the Dow came really close to producing a new 5% move. We got to like 4.7 some odd percent. Now we're at a minus 3%. So now we're moving back up to the point where even that 6% number might have a good chance of getting bigger too, if the Dow can really catch up to where the S&P is. The Dow is really below that high, but the S&P's not, so the Dow's got a lot of catching up to do. All right, now let's take a look at it, at this move in equities from an asset class standpoint compared to some of these other asset classes. And let's go just to today first, and then we'll zoom out to the full week. But if you take a look at today, oops, there we go. You can see the big move higher at the very end of the day, and S&P especially, IWM to a degree. The Qs really ramped up today as well. The developed market stocks did okay. Real estate did okay. And you can see commodities were down. Bonds did okay. And that's really one of the bigger reasons why we've had the move is we're getting a pretty decent, oops, sorry. Let me get this here. If you take a look at the 10-year yield, coming back down after a couple of big strong days to the upside early in the week. On the last 2 days, going from 4.62 down to 4.51 is a big change in direction. So this is actually a really good sign. We had jumped back above the 30-day moving average. The MACD had turned positive. It's still above. It's still positive. It's still above its moving average. So it hasn't reversed. The stochastic's still above its moving average and still in bullish territory, despite its small decline. So it hasn't reversed yet. We're still above the 17-day exponential moving average, but at least we're not like in like kind of rocket ship mode, which was really putting a little bit of pressure on risk assets, small cap stocks in particular. So that's a big reason for for the move today. And you look at like that dollar index. Here, let's pull up the dollar index here. And you can see it's dropped the last couple of days too. And so that's been a big fit. In fact, if I were to, let's zoom this out. Let's go back out here to our comparison chart. But let's look at the last 2 days, and then we'll look at everything else after that. So there's bonds. So again, bond yields are down. The dollar was down. Commodities are way down. That's your three-headed monster. Yields down, dollar down, commodities down. Has been very bullish for equities. And it wasn't really initially, but it's supposed to be, right? Small cap stocks did really well. Developed market stocks did very well, even if the Qs and EEM didn't. But finally, they started to pick up the pace at the end, and they caught back up to where some of these others were trying to get to where some of these others were, and real estate really taking off again with the falling yields. Zooming out to the beginning of the week, again, we only had 4 days this week, so bond yields were higher initially on the week, and that kind of put some pressure on IWM, especially. It was down 1.5% in those first 2 days. Small cap or large cap stocks were down a little bit as well. Commodity prices were higher, the dollar was higher, yields were higher. But then changed, right? Things changed to the point where bonds still finished the week down, so yields were still higher on the week, but things came off of their lows. IWM especially well off of its lows. IWM finished the week positive. After being down again 1.5% on at the first 2 days, by the last 2 days finishing the week above zero. So nice change in direction there again because of that move in the rebound in bonds, the drop in yields, and the drop in the dollar. Now the question is whether or not that will sustain itself, and I think the expectation is it will be harder. The 10-year yield can actually move a little bit more. It's got some more room to the downside before it gets because if you start breaking too far down, then again, there's a reason why yields are falling hard, and that's because economy is really struggling, right? Economic growth expectations are starting to diminish. So we don't want that, right? The 10-year yield shouldn't. If you look at the yield spread. The yield spread, you don't want it to be too much to the downside here. Let's actually look at this version here because it'll be updated better. Here in the last couple of days, you can see the spread has really improved. Let's go to the 5-day chart so we can see kind of an intraday look at it. So here early, going into yesterday, we were at about 80 basis points. And we were working in the wrong direction. Well, now we're back down to 90 basis points. As you can see, that's a much better situation. Looks like, about 90 basis points. That's a much better situation than where we were at earlier this week when it was really rising. Because again, we don't want it to get too high. Like, if it gets too high to the upside, that's generally because either the 10-year yield is rising up to 5%, and that's only because inflation expectations are rising, or the short-term rates, the 3-month bill, is really starting to drop, and that's because of Fed rate cuts. And again, there's only one reason why the Fed cuts rates, especially considering that the economy is not slowing to a large degree. The velocity money is still there. Like there's no, like, financial conditions are still very looser than they were when they started raising rates. So they're not like, the rates aren't too restrictive. They don't have to like lower rates because they're too restrictive. So if they start to lower rates, it's because things aren't looking so good, right? From an economic standpoint, things aren't looking so good. And you can see rate cut odds still, when you look out to like the month of September, you're still at almost a 50-50. It's been fluctuating in the 40s and low 50s. You can see a month ago we were at 54, and now we're at 46. So we've been fluctuating around here. Here's the what it looks like there. So we've been fluctuating around the 40s and 50s, but there's still still a pretty decent chance that we don't get a rate cut in September, and that would be the best case scenario. That we, at the very earliest, wait until December. Right now, there's about a 17 or 16% chance of that happening. That would be, if we can push that to 0, that would be ideal too. Because keep in mind, we're about to have the June 12th meeting. Well, just a few months ago in January, we had a 90% chance, an 88% chance that we would have our third cut by now. So the fact that we don't has been good for the market. The markets have been really bullish. And so now, if we can price out, we started to price out September, because by September, if you look at January the 12th, we were looking at 4.25 to 4.5, 99% chance that we'd be at 4.25 to 4.5. Well, that is, let's see here, it'd be 1, 2, 3, 4 cuts. We had a 90% chance that we'd have 4 cuts by now, by the September meeting. And we're at a 50-50 shot of not having it. So the more we price them out, the better the market will be. The more that we actually start to get those, then there's a reason. Again, especially considering financial conditions are not too restrictive. So if they're cutting rates, it's not because of restrictive conditions. It'll be because they have to stimulate aggregate demand, because it's starting to really drop off in a very bad way. So obviously that's not happening yet, and that's why the stock market has been able to maintain, and probably will continue to maintain, at least I expect it will, a bullish trend through this summer. I don't think it will be a big strong move. I don't think, because I do think that after we get this zigzag, I don't think we're going to get another 19% box or a 27% box. I do think that after we get to 8 to 10 in this one, that we will get another 5% decline. That will be temporary, just like this one was, before we continue higher towards the end of the year, and we'll see what we end up getting there. Let's take a look at the sector chart. So give me 1 second here to check that out. And let's go to the last couple of days first. And you can see here, let me look at this is the fascinating move. So XLK rebounded finally at the end of the day today, but and S&P was bullish over the last couple of days, finished bullish, up 0.25%, even though it was bearish most of the time. But look at like XLY, XLC, XLK were the biggest losers. And look at like real estate up 3.5%, utilities up 3%, energy up almost 3%. These are sectors that don't typically do well when the markets are bullish, and they've had a really, really good couple of days. If you look at the whole week, they were the only sectors that were positive for most of today. By the week, by the end of the day, we had discretionary and communication services join them along with financials there, but XLK is still really lagging behind. Despite at least we finished with some much better improvement, but still down 2% on the week that was. This isn't the leadership that we want to lead the way up to the upside. When you look at the sector rotation here on this chart, we like to look at that relative rotation graph. You can see here technology is really losing ground. Utilities, which has been in the weakening category, but it's still, you know, relative strength. Both these two boxes show better than average relative strength. It's the momentum is picking back up in utilities. Communication services is finally working its way from not really moving to into the leading category. Energy, this is XL. See, that's XLE over here. Where's XL? No, that is XLB. Nope. P. Nope. What is that? XLE? Oh, it is XLE. XLE is right on the border. Here it's showing in the blue, so it's showing in the improving, and here it's showing it's still in the red. But it's right on the cusp of being there in the improving category itself. And you can see everything else that's starting to turn up. Materials is turning up. Industrials is turning up. Discretionary is turning up. Financials is turning up, right? Turning up a little bit there. So it's not the cyclical areas with XLK and XLC and XLY, but it's everything else that's starting to show some improvement. That's which also means that we're getting improvement in breadth. Look at that. After dropping below 200 on, what was that, Wednesday, which is a very important level, we rebounded all the way back above 250. So we're back above the 50% mark. Now, we're not above the moving average yet, but at least we're back above the 50% mark. Very, very important return of breadth. Look at that big jump in breadth. So that's a good sign for the markets. The new highs and new lows index, which has gone positive, is back up. It's not above 100. It's not above its moving average, but at least it's not negative anymore. When you look at the McClellan oscillator, which had been pretty darn negative this week, it's rebounded back to where, I'll pull up here, where it's barely negative at all. It's been kind of flirting with that zero level there. So that's a good sign for risk appetite. And then, of course, the money flow. Remember, the volume was very, very good today. We're still in bullish territory, and we're rebounding back up. Now, again, we're not back up to, we haven't crossed the highs, but again, rebounding in a very, very good way on the breadth here is a very good sign. So it's much better this go around. You can see we're already, and this is where the volume was at the recent peak, and we're already almost past it. With this move that we had, even though we're not, you know, we're still a little bit further away on price, but money flow is looking a lot better. So, you know, while we haven't been that great for most of this part, that's a good bounce. Now we need to kind of build on that. We need to build on that next week, but that's, you know, you can't ask for a better end to the week to start us off on the right foot for a new month than what we saw in this last hour of trading here. All right, let's look at our trade idea of the day. We'll take a look at Datadog. Datadog had a pretty negative earnings, pretty negative response to its earnings result. Let's try this again. You can see down. It didn't really get that big of a rebound here at the end of the day today. Dark pink shading in a red line. We closed below all, you know, the last couple of lows that have been in this area. Down to 110. The intermediate line has fallen almost into bearish territory there. Short-term sentiment's pretty negative down to the downside. You can see 9.5% below the moving average. If you take a look at the long-term view, we close almost right on the 40-week exponential. Obviously, we closed below the 10-week. We got the red arrow this week. Bearish candle. Pretty decent lower body too. Remember we're trading at 110 right now, and next week's body, is going to open around 119. So we're going to get a pretty decent sized bearish candle to start off the week next week, and we'll be well below the 40-week exponential. So definitely a change in trend for the stock, to say the least. So obviously you have three green arrows on the chart. You broke below the 200-day moving average today as well. The 8 and 17 have been below the 30 for a while. They're still below that. The MACD is dropping below its moving average. Stochastics is dropping below its moving average and rolling over. If you look at some of the other oscillators on this, You can see the DMI has got a good bearish breakout pattern down there. If you look at the RSI and the CCI, it also has a pretty bearish breakout pattern below 40, below minus 200. The weekly CCI way below minus 100, down below minus 200 there. And it doesn't even look like we're that extreme. So it looks like we're, this doesn't look like an exhaustion move. It looks like more of a trigger move that triggers a trend instead of exhausts a trend. And if you look at like the Ichimoku cloud, you can see we're well below the cloud. Rate of change is very negative. The green line is below the blue line. We have the beginning of a weak bearish trend. So we don't even have like, a full-on mature bearish trend yet. This is just a weak one that's just barely starting. So, again, it looks like this is the kind of move which is pretty significant, but one that triggers a move to the downside with the break of the bands and the break of the Keltner channels. The bands themselves are actually still inside the Keltner channels. The momentum is barely turned negative again. So we have an opportunity here, I think, to start to move to the downside. So what I did on this trade is I came out to its options and I did a bear call spread. So we sold the 114, bought the 116. At the time was a low 30s delta, mid 30s delta. You can see the break even there. If I were to throw that break even onto the chart, that break even is right above today's highs. So we essentially would have to get back above this little breakout that we had to the downside, which you could qualify as a breakaway gap because we broke that 200-day moving average and we went down, run away from the open. So you can qualify that as a breakaway gap. We'd have to completely reverse that, fill in that gap, which you wouldn't expect that we would, but it's not 100% odds, right? So that's why we position size. So if it does, then that's when we would get out, ideally with no more than a $385 loss if it doesn't work in our favor. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody. There won't be a Market Outlook live on Monday. We'll be back on Tuesday of next week, so we'll be back on Wednesday. We'll take a look at how the first 3 days of the week ended up. We'll talk about how, hopefully, how the market has continued this little late week move this week into next week. So thanks again, everyone, and we'll see you all next Wednesday.